Oh, how you can hear me? Just wanna arrange my microphone. Is everybody here? So today we have a 7 attendees. Not so bad. Yes, right, very well. Okay, so let's start with practical exercises that I have given to you as a homework. So let's start doing this. Check the practical exercise first, then we continue with the theoretical chapter, then we will back on the another one, practical exercise based on calculation of depreciation. So here is, I prepared you the presentation based on the exercises with already with the right solutions. The first, exercise number 1, the balance sheet. Based on the balance sheet, let's see. Matching the exercise, match the items on the right with the items on the left. So solution for exercise number 1, we can see on the presentation. Here is the items of monetary value which have a long-term function and can be used repeatedly. Of course, it is fixed assets. The current assets, anything owned by the organization which is likely to be turned into cash before the next balance sheet date, usually within 1 year. Anything owed by the organization which is likely to be paid in cash before the next balance sheet date, usually within 1 year. This is the current liabilities. What is long-term liabilities? Debts the creditors falling due after more than 1 year. This includes medium and long-term loans, debentures, and possible provisions for tax payments or other long-term debts. And the capital is to the business person, means funds invested in the organization, either from the shareholders, share capital, or the individual owner in a sole trader organization. I have received around 10-12 assignments from students. Most of you done rightly, correctly, this exercise number 1. That is good. That's very good. So let's move to the next one. I hope you are fine with the exercise number 1, right? You already do understand the meanings of the assets, liabilities, and the capital. Yes, it's clear. Let's see the next. Exercise number 2, the balance sheet. The list of accounts is given in alphabetical order. Prepare the balance sheet ending December 31st, 2010. So the table 1 helps you to put accounts in the right place. I was giving you the table that prepare for you to be easily find the solution. So here is given accounts, and then the figures with the accounts in US dollars. So accounts payable, accounts receivable, cash on hand, common stock, depreciation, the garrison equipment, inventory, land owned, long-term loan, other intangible assets, retained earnings, and taxes payable, right? Here is the notice, as you can see, the retained earnings counts with a 0 number. So most of you have missed these accounts in the balance sheet. Anyway, if any accounts comes with a 0, you must show that accounts with a 0 one. You can't miss it in the balance sheet. And next step, the second note with depreciation. Here is given 12,000, which is depreciation is our expenses and must be deducted from our fixed assets, right? So let's see the solution for exercise number 2. Some of you are asking me what is the depreciation. First, we we'll finish the exercise. Then we will continue with a new chapter where is given the definition for depreciation and as some examples and the calculation for depreciation. Just be patient, please. So the solution for exercise number 2. Here is the table 1. This is first, actually, the table is so big, so huge. I divided for 2 pages. So in the first, you can see the assets. So here is given the current assets, the cash on hand. Of course, this is current assets, account receivable, and inventory. And total current assets would be 50,000, right? The next comes is fixed assets. Is garage and equipment, 40,000, less depreciation. You must show like a less depreciation in 12,000. Land owned, other intangible assets. And total fixed assets would be 38,000. And total assets, 88,000. Here is look at depreciation. The less depreciation. The depreciation we should put under fixed assets. Actually under the garage and equipment. Some of you just have deducted and already put the last figure, like 40,000 minus 12,000 would be 28,000. This is not correct. You always must put the accounts in the balance sheet on those terms that is given to you. You can just deduct in your mind and put it already in the balance sheet. Already deducted one. You must show everything, any accounts in the balance sheet, because the people, as you know, any account must see. As in mine, for example, I'm director. If I can see the garage and equipment only 28,000, how I can know how much is historical cost and how much the depreciation you have been deducted. And you must remember the accounting principle for the fixed assets. You always must show the historical cost for fixed assets. So this is the first principle. You must show the historical cost for the fixed assets. Then if you have some depreciation, you will put after the fixed assets, you will less as depreciation. Let's see the liabilities. I think this is you all right with the assets, right? Let's see the liabilities. So here is liabilities and shareholder equity. We have accounts payable, which is the current liabilities, taxes payable, long-term loan. Long-term loan is long-term liabilities, right? And shareholder equity, we have a common stock given to you, 45,500, and retained earnings. Do you remember we had the accounts as a retained earnings with a 0? We must show anyway if we have these accounts in the exercise. And here is given the total shareholder equity, 45,500. And in totally, the liabilities and shareholder equity will be 88,000, which is equal to the assets, right? See, here is the equal. We have a balance assets between the assets and liabilities, right? So this is the solution for exercise number 2. If any of you have some questions related to exercise number 2, just let me know. I think this is clearly. I don't know, some of you put the common stock on the fixed assets. Common stock, that is the shareholders' equity. You must remember these things. So I think that would be okay. So let's see the next exercise. So the exercise number 3. Is it okay? We move to exercise number 3. Okay, let's see. So we describe a limited number of transactions of a newly created consultancy company in year 1. So assignment, the prepare income statement for year 1. So you must be very carefully with the given assignment that here is given. You must prepare the income statement for the year 1, not include the year 2, only year 1. So let's see, the first one we have is the owner contributed 5,000, brought in cash by issuing 500 shares at a nominal value of 10 each one. To start the operations, the company borrowed on the 1st of January 5,000 at an annual interest rate of 5%. Interest and repayment are due in January of each year for the next 5 years, starting from the year number 2, right? The company provided 22,000 of consulting service to 8 customers. So this is our revenue, you must remember. And the work is totally performed and the invoice have been sent already. So corresponding the cash payments amounted for 20,000. The number 4, a consultant is hired on a partial time basis. That means we hired a staff, and he earns 16,000. So we pay him the salaries for 16,000, and corresponding cash payments in year 1, 2 were 10,000 only. So the company paid 2,000 for the advertising cost. So we put some, we have some advertising costing, right? Number 6, additional miscellaneous operating. The miscellaneous means the petty operating expenses, the small expenses were incurred for 2,000, of which the 1,500 are payable at the end of year 1. So new contracts with the value of 42,000 were signed in year number 1 and will be performed in year 2. All cash payment will take place in year 2. So this is very important. The number 7, look at here, is we have a new contract with the value of 42,000, which is signed that only the contracts have been signed in year 1. But the cash payments will be taken in the year number 2. So it means we won't take this account in our income statement, because the payment will be held only on the year number 2. So next one, the results are positive. The owner decides to pay a dividend of 800 out of year 1 earnings. Cash payment is made in year 2. So this is also very important. Some of you have been mistaken with number 8. Here is the sheet. The results are positive, right? That means we have a profit. And the owner decides to pay dividend of 800 out of first year earnings. So he decides to pay the dividends to shareholders. But here is the cash payment is made in the year number 2. If here is given that the cash payment will be made in the year 2, that means we are not taking these accounts in our income statement, because we are going to prepare the income statement for the year number 1 only. So in this situation, the last two transactions won't be held on the income statement for year 1. They will be, let's say, they moved on the year number 2. Is it okay for you? So let's see the solution 1. So here is solution for exercise number 3. There's given to you formula for income statement. As you remember, the revenues minus expenses equal to net income. So you must always remember. This is short formula. If you remember this formula, you can easily prepare the income statement. Here is given first, operating revenues 22,000 is from the you see I have given to you just as additional information notes. We are shown the total revenue from the transaction number 3. Total revenue. Here is let's back. We have, as you remember, we have as a company provided the consulting services to 8 customers, right? And total our total revenue will be 22,000. Some of you put the 20,000. 20,000 we put only in the balance sheet, on the trial balance. When we prepare the balance sheet, we put like we have a sales revenue on the 20,000 and 2,000 in its accounts receivable, right? But the income statement, we must show the total revenue. We always must show the total expenses and total revenue right here. And next one, the operating revenues, and we must do, as you remember, based on the formula, minus expenses, minus operating expenses. Here is given salaries and social charges, right? That we paid for consultants, 16,000 is from the transaction number 4. Advertising cost expenses, 2,000 from transaction number 5. And we have other expenses. This is TT expenses from the transaction number 6, right? And total operating expenses will be 20,000. 16,000 plus 2,000 plus 2,000 equal to 20,000. Then operating revenues, we will deduct the operating expenses, and we will get the before interest and taxes, the profit before interest and taxes, 2,000, right? Next one, we some of you just stopped with these lines only, but we always must show our interest revenues, the interest expenses, or taxes. Interest expenses and taxes. The interest expenses is 250. This is from sorry. This is from transaction number 2. You remember we borrowed the 5,000 at 5%. Let's see. Let's back number 2. Sorry. So to start the operations, here is the company borrowed 5,000 at the interest rate of 5%, right? And the interest and repayment are due in January of each year for the next 5 years, starting year 2. Here is, at the end of the year, we must pay these interest expenses. And 5,000, we will, from the 5,000, we calculate the 5% would be 250. And we must to deduct it from our profit before interest and taxes. And then we will get the earnings before taxes, as you know. The earnings before taxes, 1,750, right? Then we must deduct our taxes. The taxes comes always at the end of the income statement. But we have no taxes because we are in the exercise. Is not given. Also, it's not given any transactions below to the taxes. That means with taxes put 0. If it's not mentioned, we just put 0. And net income will be 1,750. So this is the income statement. So that's all. So any questions? Most of you have been mistaken with the income statement, with the exercise number 3. I do understand because we haven't done any science based on this. You have seen only the examples, but that's all right. We do more exercises later. You don't worry. So, just when I have some questions from the students. Some of you have been forgot about the interest expenses. Here is given. Some of you have been forgot about this one, interest expenses. Yes, I know, but you must put it always. Don't miss any transactions. Any transactions are important. So, of course, I will send you all the presentation after the class. Don't worry. So I hope you You are well done with those exercises. Uh, so if not any question, we start our session from the chapter 3. The measuring and reporting financial performance. In this chapter, we learn about the depreciation. Is it okay for you? Sorry, I have some questions from the Mr. Barak. Sorry, he has some questions. Just a moment. We must to back on the exercise number 3. Salaries and social charges. So, Mr. Barak asked me that about the transaction number 4, the salaries and social charges, that given 16,000. Here is, let's see, sorry. The consultant is hired on a partial time, yes, and he earns 16,000. So we paid the salaries, to him the 16,000. And what the corresponding cash payments in year 1 were 10,000. Mr. Barak, you must remember, here is given that the corresponding cash payments in year were 10,000. That say that he paid only 10,000 in the year number 1, right? But the total expenses already we know is 16,000, and we must show in the income statement total expenses as a total revenue. Same. Because he made in the balance sheet, you will show only 10,000, and the others, the 6,000, you will show as the accounts receivable, right? But in the income statement, you must show the revenues and the expenses in total figures. But if it's already the part of sum of expense is already done, but besides of the transaction number 7 and 8, here is like the sign in where is the contract having signed in the year number 1, but the payment will be taken in year 2. This is totally will be given in the year 2. That's all right. I think Mr. Barak, he do understand, right? So okay, good. So let's start from the chapter 3, which is about the measuring and reporting financial performance. Just a moment. So this is totally below to the finance sessions. Before we have done some accounting skills. Let's start the finance for non-financial users. We have to understand what the finance finance consultancy do in the when they operate in the business actually. So the topic and the structure of the lesson. What is it? We will learn about the profit and loss statement. This is the actual income statement. The profit measurement and the recognition of revenue. The profit measurement and the recognition of expenses. And the calculation of depreciation. The profit measure and stock costing methods. The profit measure and the problem of the bad debts, and interpreting the profit and loss account. So the profit and loss account it's income statement. It's another given name for the income statement, the profit and loss statement, right? So you won't be confused, because we are continuing right now. We are continuing the slides with the income statement. I mean the session with the income statement. So let's see. The key terms you must be able to use: the profit, revenue, expense, gross profit, trading and profit and loss account, the net profit, cost of sales, accrued expenses, prepaid expenses. Let's see. Depreciation, bad debts and provision for bad debts, residual value straight line method, reducing balance method. This is a straight line method and reducing balance method. This is a depreciation, the calculation of depreciations, and LIFO fee for the costing. Weighted average cost. This is evaluation of the inventories. So let's see the each other in the separately. So we have as the profit and loss account. The measures and report how much profit has been generated over a period. The profit loss for the period is the difference between the total revenues and total expenses for the period. And total profit and loss account links the balance sheet at the beginning and the end of the financial period. So you must remember that we always do prepare the profit and loss account each year at the end of the year as income statement. And the formula is always for income statement, the revenues, the difference between revenues and total expenses. Which you remember, the revenues minus expenses would be net income, right? This is our profit and loss account. The profit and loss account of retail business will first calculate the gross profit, so you must remember, and then add any additional revenues and then deduct any overheads for the period. The final figure derived is the net profit for the period. So the formula is like this. For the retail business, you must remind the gross profit. We will first calculate the gross profit. The gross profit the gross profit plus any additional revenues. Maybe we have some another revenues, like we have some another trading lines, for example, and we deduct it minus them overheads for the period, which means the expenses. The gross profit represents the difference between the sales of the period and the cost of sales. The gross profit, it's the formula for gross profit, the sales minus the cost of sales. This is for retail businesses. Some of you asking me about the profit and loss account is the same as income statement. Yes, the profit and loss account is the same as income statement. This is the same things. Income statement, we say sometimes we call it the profit and loss account. As you can see, the formulas are same. So let's see the next one. What is the cost of sales? That cost of sales may be identified by either matching the cost of each sale to the particular sale or by adjusting the goods purchased during the period to take account of opening and closing stocks. The classification of expenses is often a matter of judgment, although there are statutory rules for businesses that trade as limited companies. So there is given the definition, what is the cost of sales, and formula as like this. The cost of each sale to be particular sale or by adjusting the goods purchased during the period to take account. That means we will check the opening stocks minus closing stocks. This is the formula for cost of sales. Now, this all related to the retail businesses. So next, see, the realization convention states, you remember we had the accounting principles. We have some convention principle which state that the revenue is recognized when it has been realized, right? And the matching convention state that the expense should be matched with to the revenue that they help generate. And a particular expense report in the profit and loss account may not be the same as the cash paid. This will result in some adjustment for accruals and prepayment. So you must remember some expenses which is reported in the profit and loss, they may be not done by the cash payment. And we call them as accruals and prepayments. Those expenses having been made. We will see the definition for accruals and prepayments in the next one. So P&L is the profit and loss. So with the accruals, It's expenses which is incurred but not paid for in the accounting year. So this is accrual. This is expense which is not paid in the accounting year, but will be paid in the next. And nevertheless, this expense must be recorded in the accounting year. But anyway, we must put those expenses in the our income statement. And let's see the prepayment. The prepayment expense that have not been incurred, but the amount have been paid in the accounting year. That means this is expense we already paid for this expense, but the invoices from our suppliers, for example, we haven't get it, the invoices. We haven't received the invoices, but we already paid for those expenses. And expense been paid in the current year, but not treated as expense in the current year. You must remember. And prepayment, we call it as a prepayment. It means this kind of expense we must pay in the next year, but we paid in this year. And we always show in the income statement as a prepayment. But we must show in our income statement because this expense already made. We already paid by the cash, for example. Let's see the next one. What is the depreciation? Now we are going to move on the depreciation, on the understanding of the depreciation, how to calculate the depreciation of the fixed assets. We will see the methods of the depreciation. So depreciation requires a consideration of the cost, useful life, and residual life value of an asset. It also requires a consideration of the method of depreciation. So depreciation means it's you must remember that any fixed asset, they have a time value, right? And they are not going to use on the long term. I mean, based on the long terms. And we must deduct the depreciation from the fixed assets. We have two kinds of methods how we can calculate the depreciation. This is a straight line method of depreciation, which allocates the amount to be depreciated evenly over the useful life onto the assets. And the reduction balance method applies a applies a fixed percentage rate of depreciation to the written down value of an asset each year. So depreciation is our expenses based on the fixed assets. So now we see the definition in the detail, so you would be able to understand the depreciation. So let's see. Fixed assets are those assets which are of long life, right? To be used in the business and not bought with the main purpose of resale. The fixed assets like buildings, like land, or some motor vehicles, the automobiles, we buy for the business and we are not going to resell it, I mean in the futurist time. And they are for long life, we are using it some 10, 20 years, right? Maybe more than it. And tangible fixed assets such as machinery. So you must remember, tangible fixed assets is a machinery. Motor vehicles do not last forever also. So this is kind of assets, machinery, motor vehicles, they do not last forever. And we always must deduct depreciation, like amortization, which is from those assets. If the amount received on the disposal of the fixed asset is deducted from the cost of buying it, the value of the fixed asset can be said to have depreciated in value. So in always the fixed assets we show the historical cost of the fixed assets in the any balance sheet or income statement. But if we have some kind of depreciation, we are going to calculate them. We must put under the fixed assets as our expenses. We must less deduct, I mean, depreciation from the fixed assets. So depreciation is that part of the original cost of a fixed asset that is consumed during its period of use by the businesses. It needs to be charged to the profit and loss every year, and it reduces the net profit. So you must remember, when we prepare the profit and loss account or income statement, we always must show in this statement the depreciation. And it reduces means our net profit. That means our net profit become less than we have actually. And the amount to be charged in a year to profit and loss for depreciation is based upon an estimate of how much of the overall economic usefulness of fixed asset has been used up in that accounting period. So I know this kind of definition is hard to understand, but later we have some exercises and you can easily understand the meanings of the depreciation. Okay. So let's see. What kind of causes of depreciation we have for the fixed assets like motor vehicles, equipment, and so on. So physical deterioration, which is you can see wear and tear, erosion, the rust, rot, and decay. Economic factors like obsolescence of date, that means the useful life is already have been end. Inadequacy, no longer in use because of the growth or changes in the size of the businesses, for example. The time, a legal life is in terms of years, rent or and patent. Like normally is used the term amortization. We say amortizations, time, and depletion. As assets are wasting harder due to the extraction of raw materials from them, and so on. So this is some just giving you examples, which call the examples of the causes of depreciation. So let's see. As you remember, we have two kinds of methods: calculation of depreciation. First is a straight line method, and based on this example, we can see how we can calculate the depreciation. So here is example. If a lorry was bought for 22,000, would be kept for 4 years, and then be sold for 2,000, the depreciation to be charged each year would be. So here is saying that the business, the company bought the lorry for 22,000. And the business is going to use it only for years, and then sell it for 2,000. So, and based on the formula, the straight line, we are going to take the 22,000, the historical cost that we bought the lorry, minus the estimated disposal value 2,000. That we are going to, you remember, we are going to sell this lorry for 2,000. That 2,000 like is given like our benefits, not the benefits, like some our profit for 2,000, 22 minus 2,000, that this sum will be back to the company and divided to the 4 years. Here is. And here is, and it's equal to 5,000, which is depreciation each year for 4 years. So each year we must deduct 5,000 from the 22,000. So in the income statement we show for example, the equipment equal to 22,000. Less depreciation, which is the 5,000, right? And it is equal to 22,000 minus 5, 17,000. So in income statement, every year we show based on this example. And next year will be 22,000 minus not 5. In the year 2 would be like 22,000 minus 10,000, because it's year number 2. We are taking the depreciation from the 2 years, and it will be increased for 2 years. If it's increased for 2 times the depreciation, it will be 10,000. I think this method is simple one. You can understand. You always, if you buy some equipment and then you are going to sell it, of course you know how many years you're going to use it. Like here is given 4 years, so you must check a total cost for the equipment minus the disposal value that the money will be back to the company, and divide it for how many years you are going to be used. And you will get the depreciation, which will be calculated each year. Here is going to repeat you 22,000 minus 2,000, which is sold for 2,000. This is disposal value, the estimated money that will be back to the company, right? Divided, here is for 4. It's a 4. That means here given that the lorry will be used 4 years, right? And we divide for 4 years, and then we have it will be equal to 5,000, which is 5,000 is depreciation for each year. $22,000 minus 2,000 will be 20,000, which is 20,000 equal to divided for 2 will be 5. How some of you have been mystically, the Mr. Akmal is given right answer. Just wanna copy his answer and send to you. Here is this is a formula. 22,000, which is the cost of the lorry, minus 2,000, that the money will be back to the company. It will be 20,000, right? And divide for 4 years, and each year we will be get the depreciation for 5,000, right? So are you agree with that? Give you 1 minute to understand this one. The next one, I have some practical exercises. And so here is given to you. In the income statement, we show the profit and loss account. We must show our depreciation, right? Based on the presentation. So we show our equipment for 22,000, and we less the depreciation, which is the 5,000. This is for year number 1, and it will be equal our equipment 15,000, right? Like going to type you just. So in the income statement, I haven't prepared this one. It will be good for you just one. Income statement, like we show you remember we have a equipment like this. Equipment would be 22,000. Then we less the depreciation. So in the income statement, you see, I have typed you. The income statement, we show our equipment for 22,000. We less the depreciation for 5,000. And, oh, sorry, it's not 15,000, sorry, 17,000. My mistake, sorry, my mistake. This is, I can show you based on the For example, based on this one, based on the previous exercises. Just a moment. You remember garage and equipment, we had the 40,000. Let's put, here is, we must put like 20,000. Like here is, we put like 20,000. Oh, based on our straight line. Yes, 22,000. We put like this. Less depreciation, which will be 5,000, right? So we do like that. This is the less. This is for year number 1. Just a moment. So let's see. Based on the solution for exercise number 1, we put the like equipment and garage for 20,000, and we less our depreciation for 5,000, right? And our income statement will be decreased for 5,000. So any kind of questions? Just a moment. So depreciation always be calculated from the total cost of the equipment or any assets. You see, we must take a history, the cost of the total lorry for 22,000. Some of you say that, yeah, some of you have some kind of confused questions. So let's see the next method, and we have some exercises. We can do it, and you can easily understand. So this is, I think, this simple formula. Let's see the like a reducing balance net. Next one. If the machine is bought for 10,000 and depreciation is to be charged at 20%, the calculation for the first 3 years would be as follows. So we are going to calculate the machine for first 3 years. So you remember our cost here is our cost is 10,000. So we bought the machine for 10,000, right? The reducing balance method, based on the formula that you must deduct it each year based on the percentage given to you, the rate of the depreciation. So the first year depreciation would be 2,000, right? Because the 10,000, the 20,000 or 20% from the 10,000 would be 2,000. This is just one type for you that you could be easily understand. Some of you asking that 20% is specific in accounting concept or no. Not actually in accounting we have a list of special list of the depreciation rates on the fixed assets. For example, like land will be like 18%. The machinery, the vehicles, like equipment, will be 20%. So for each of accounts, for each assets, the percentage will be different one. If in the accounting, if you would like to calculate this, you have to find this list of with this the rates one for the depreciation. I think I can find for you and send it to you, don't worry. But always for machinery, for vehicles, for equipment, depreciation, we calculate for 20%. So yes, it's very important to know uh, how many percentage we have of the depreciation we have for any assets. So here is the cost is 10,000, right? The first year depreciation 2,000 because based on formula 10,000 we will here is 10,000 we multiply it for 20% we will get 2,000, right? And the cost here is 10,000 minus 2,000 will be 8,000, right? This is how it's given to you. Just so 10,000 minus 2,000, and the total cost of the equipment of the machine will be 8,000 for the year number one. The year one. Here is let's see the next. Let's calculate the next year. The second year depreciation. So from the second year depreciation, we must take the figures which is given after 1 year depreciation, which is deducted already. Here is given to you 20% of. We calculate 20% from the 8,000, and we will get the 1,600, right? And 8,000 minus 1,600 will be 6,400. So this is for the year number one. For the year number one, we must get the costing of the machine, not the total one, not the previous, not the historical one. The 10,000 we must get. We must take as I told you, from the year number one. After the depreciation of the year number one, here is just one have been just typed for you. So year number two, we calculate like 8,000 minus 1,600 would be 6,400. The 1,600 is just like that. The 20%, which is multiply to 8,000, right? Here is you must. Yes, I already typing for you on the chat box. So this is second year depreciation. After second year depreciation, we will get the machine costing for 6,400, right? Let's say the third year of depreciation. So here is given the 1,280. Here is must. We show we must get the 6,400, which is the costing of the machine after depreciation from the year number two, and multiply it for 20%, right? And then we will get the 1,280. This is the year number two. Nobody can see my. Some of you see that they can't see my chat box. Actually, I'm trying to host, present, and panelist to all of you. Sorry, host, presenter, panelist, all participants. I must choose a different one. Just a moment. Sorry. All participants one. Okay, okay, don't worry. I'm going to give you again that formulas that I. Can you see? Oh, sorry. Can you see right now? I just type for you because yes, sorry, my mistake. So let's see. So the depreciation year number 3. Uh, we will calculate like 6,400 multiplied to 20%, which is the rate of the machinery, right? It will be equal to 1,280, right? This is the year number 1. And then to see how much costing for the machine we have for the next one, here is we must deduct from the 6,400 minus the depreciation, which is 1,280 is depreciation. So it's equal to 5,120 for the year number 3. Curious. So can you see that they have been typed for you? So this is the reduction balance method. So what that means? The reduction balance method. We do, of course, we do depreciation every year, right? We must do to calculate our depreciation every year, but in the reduction balance method, we must deduct the last figure from the depreciation, like how much we get from the first year number 1. We have a balance for 8,000, right? And this 8,000 will be moved on the next year for the year number 2, right? Here is from the 8,000 we will going to deduct our another 20% of the depreciation, which is a 1,600, right? Then we get the balance for 6,400 for the starting year number 3, right? This amount will be shown in the statements. So this is always like this. In the income statement, we use 2 kinds of methods, which is the straight line method first, or which is the reduction balance method. Let's see the choices of method. Which method would be good for you to choose? So, for example, the method selected should be that which allocates cost to each period in accordance with the proportion of the overall economic benefit from using the fixed asset that was expended during that period. So that means you can choose any method. It's depend on your businesses, on which method will bring you the benefit in your income statement. If you would like to reduce your let's say reduce your income statement, you reduce your profit, for example. Let's say that, as you know, at the end of the year, we prepare the income statement, right? And we must pay the taxes. Most of company, they use the method like, if you are a startup company, just open your company. The better for you if you use the straight line method, right? Because you can show that here is the amount for the depreciation would be huge one, like a 5,022, and your income statement will be decreased more than the for 5,000, right? Decreased, and you can show that your profit is less than it is actually, for example, and you pay less taxes than should be. For example, you pay taxes based on the your profit, right? And if you use the reducing balance method, here is this is good for the companies which is using the equipment already long time, and of course the costing of the equipment is reducing every year. And for example, in the like this, in the example, the year number 3, you can show like your depreciation, like your the machine costing is a 5,180 only. Of course, your income statement will be decreased, and you can pay less taxes as if you use the another way, as I told you, for the straight line method. It depends on the businesses, how it's comfortable for you, how is more which kind of method would bring you more benefit. So, and let's see, here if the main value is obtained from the asset in the earliest years, it may be appropriate to use the reducing balance method, right? If the benefits are to gain evenly over the year, then the straight line method would be more appropriate. The reducing balance method has a much higher charge for depreciation in the early years and lower charges in the later years. So you must remember, like the reducing balance method has much higher charge for the depreciation in the earliest years, right? In the first, second years, and lower charges in the latter years. And if you are a startup company, the better for you use the reducing balance method. If you are already in the business a long time, for you it's better use the reducing balance method also. For you better to use the straight line method. So the reducing balance method is good for startup company, and the straight line method is good for the businesses which is already long in the market. Is it okay? Just wanna type for you, like a reducing method. Reducing method is good for startup company. If you just opened your company in the first or second year, you're newly in the marketplace, and the straight line method is good for the businesses which is long in the market. This is one. So you see, the reducing method is good for the startup company, right? Because we have much higher charges on the first, second years, and our profit will be, can show our profit that it decreased, like becomes smaller than, and we can from that when we can, taxes will be less, will be smaller, right? You must understand these things. I think the most directors, they know about these things. And if we use the straight line method, when the business are very long in the market, they use the equipment, the lands, the buildings a long time. So, and their charge would be big. The charge would be higher in the later years, and then they can pay very little the taxes, because the profit would be deducted based on those depreciation. So, do you understand the choices of method? Which method is better for you? I mean, which method is better for the businesses? In which kind of terms? Yes, right? So, the formulas are easily, and I have some kind of I have exercises for you based on the depreciation. So I'm going to give you right now to share with you. Just a moment. I prepared to the exercise based on the depreciation. So when we do calculate it, I think you could understand more better. Oh, sorry. Oh, no. Sorry. This is not what I want to share with you. Just a moment. Sorry. Ah, here is, I found. Sorry. This is exercise and depreciation methods. Let's see. Here is the question given to you. A car costs 9,600. It will be kept for 3 years and then sold for 2,600. So the company going to buy a car for 9,600, right? And going to use it for 3 years only, and then to sell it for 2,600. So it requires calculated depreciation for each year using reduction balance method and the straight line method. So right now, I'm going to give you a 5-7 minutes. Is it enough for you to calculate the depreciation for each year? Because it's already 7:17. Yeah, we have time. It's okay. So I'm going to give you 5-7 minutes. I think it should be enough for you. So you must use two kinds of methods and calculate the depreciation. Here is the reduction method and the straight line method. Please do it first, and then I give you the right solution, and we can, no need to send me. You just calculate yourself, and after 5 minutes, I give you the right answer, and we can check it with the right answers. Is it okay? We can see the, no need to send me your answers, just you calculate on yourself, on your papers, and then I give you the right solution. And we will and we will compare my answer with your answers, okay? So just 5 minutes. So now is 1919. Okay, at 19:25 we start going to see the right answers. So is everybody here is do you understand the question? Hello. Yeah. Okay. Calculated depreciation. Take your the calculator and see you in 5 minutes. So dear students, you have to calculate for 3 years, not for 1 year, which means for year number 1, the calculated depreciation for year number 2 and for year number 3. Separate for each year, you have to calculate the depreciation based on 2 methods, the reduction and the straight line. So we have another 3 minutes. Thanks. So hello, I'm back. So I hope you're already calculating your papers. So just going to share with you with the solutions for this exercise. Okay, just give me. So let's see, we have solutions. Here is answer. First, let's see the straight line first. So the formula for the 3 years would be like, we are going to take the total cost for the machinery minus the value we are getting from the selling, 2,600, and divide it for 3 years, right? And we will get the 2,333 for each year. And when we calculate for each year, we have to deduct it like year number 1, the 9,600 minus the depreciation 2,333 would be 7,267, right? Year number 2, from the 7,267 we deduct the depreciation, which is we already know is a 2,333, right? And the balance will be for the year number 2, 4,932, right? Sorry. And the year number 3, we already know the depreciation is remains same, the 2,333, and the 4,000, which is the cost of machine, 934 minus depreciation, and we have a value is for 2,600. This is the cost of the machine. Would be after 3 years we have a cost for machine $2,601. This is the car cost for the machine. Just a moment, I just type you. Oh, sorry. If you can see, I'm going to type for you the meaning of $2,601 is the cost of car after 3 years usage. Yes, right? Can you see that I have typed for you? This is a straight line. So we have this is separate like that. Sorry if I didn't explain for you in the beginning. So right now we have seen the first one, the straight line, right? This is straight line method. So we have a cost for depreciation. We have a depreciation which is as you see 2,332. The depreciation for each year will be same amount, right? And each year we have to deduct it from the cost of the car. So here is we are deduct in the year 1, year 2, year 3 we are deducted the depreciation from the car cost. And at the end of the year number 3, we have the cost of car after 3 years of usage would be $2,601. This is, yes, as explained in today's slides. So this is the cost of car after 3 years of usage is $2,601. And this is already after depreciation. So do you understand? This is a straight line method. No, this is a some of you say the straight line looks like a reducing balance. In the straight lines we have a depreciation the same amount, always same depreciation. But in the reducing balance, here is we have a different percentage of the depreciation. Of course, before we haven't let's say the exercise like this. I didn't show you for each year how we must to calculate for straight line. But it is like this. Looks like a reducing method, but the amount of the depreciation remains same. You see, 2,333 for year number 1. For year number 2 is same, 2,333, and for year number 3 is same, 2,333 US dollars, right? And let's see the reducing balance. So first we show our costing, which is the total cost is 9,600, and we have a 35% of the rate for this car, and we have calculated just it means the 9,600 multiple to 35% would be 3,360. And we deduct it from the cost of machine, and we will get the 6,240, right? And for depreciation for number 2, we calculate the 35,000 from the 6,000. So going to show you maybe like that. Oh, sorry. Like this, you see. So after this year number 2, we calculate the depreciation using the balance from the year number 1, and the same with the year number 3. So here it means 4,000 multiple to 35% will be 1,420, 1420. So after that we will get the cost of car after 3 years will be 2,636. Okay. Here is, you can see the difference. Of course, you must remember that each year your costing for your equipment will be less than the previous year because we are deducting depreciation. But in the reducing balance and the straight line, the amount of depreciations are different, because in the reducing balance we have a special rate for the fixed assets, right? We have a special rate for depreciation, but for straight line we will divide it for the lifetime of the equipment, and we will get some special amount which we will use same year by year. So here is, this is just want to show you. So here is in the reducing balance we've got the 2,636 the cost of car after 3 years of usage, and you after that you can compare with the straight, which method is best for you, the straight line or the reducing balance. You see which is amount here, the amount in the reducing balance is bigger than in the amount straight line, right? After the usage of 3 years. And as I told you, you remember in the reducing balance, the depreciation would be higher first years, and the later years will be smaller. You see, the first years we have 3,360. At the year number 3, the last year we have only 1,000 420. But the in the straight line, they remain same as this one, as this one, and as this one. So I have some of you. Some of you asking me why we calculate why we have taken the depreciation rate 35,000. You can this is just given in the example, like cars. We use on the cars we use the higher rates. If you would like to use the lower than it, you can use in your businesses. Depends on your businesses. And depends on the car. If it's expensive car, of course, the depreciation would be higher than if it's like a lorry or some like different, like a cheaper cars. So some of you wants to talk. The Mr. Akmal. Just a moment, we'll going to pass for you the microphone. Yes, Mr. Akmal. Hello.
My question was answered, no problem, that's solved. Because I was asking supposed to ask about the rate of 35%. Is this the standard rate or should be based on the fixed asset?
Okay, the depreciation of rates, I think you have confused. In the exercise, you already must be it must be given to you the rate of the depreciation. But some of them are missing, and you will have later special list of the rates of the depreciation based on the fixed assets. I will send it to you later. All accounts they have a list of the rates for the depreciation.
Also, my second question is why the answer is not the same for the both methods? Because the answer should be the same. However, we are calculating in different methods.
No. Of course, we have a different methods, and we always will have a different answers for those methods. The balance will be. This is not the balance sheet. This is we just calculate the depreciation. You can use the straight line, or you can use the reduced balance method. You can use the one of two methods, which you would like for. It depends on your businesses.
But you mentioned before that for the new business, the straight line method will be better than the reducing method. Why?
If, for example, if you are a startup company, you better use the reducing balance because the depreciation is higher from the first years. Why? Because after depreciation, your profit would be decreased, right? Will be smaller because you have deducted the depreciation, and then the taxes will be calculated from your profit. And you can pay the taxes smaller than if you use the straight line, for example.
Oh, yeah, this is because of taxes.
Yeah, because of taxes.
Okay, thank you so much.
Okay, thanks. Welcome. So, of course, which kind of method you would like to use depends on your businesses and depends what you are where you're going to show your statements. If you have some auditors or you must pay some taxes, you better use the reducing balance if you're a startup company. It depends in what kind of situation you're going to prepare your income statement. Always the accounts, they already know which kind of the method is better for them. But usually, they must use one of them only. So I hope you understand this one. So I got some answers. You can just compare with your answer with these solutions. So that's fine, yeah. So we already got the answers. You do understand what is reducing balance straight line method. And after the classes, we'll send you another exercises, the practical sorry, practical exercises based on depreciation. So then you will be able to understand easily. We'll send you another 2-3 exercises, but it's almost, I think, understandable, right? And we'll send you the list of the rates for the depreciation. Always, actually, in the exercise should be given. If you don't know which kind of rate you're going to use for depreciation, you can get it from the list of the depreciation of the rates depreciation. Okay. So I think our class is going to be ended already. Yes, right. We start at 6 and it's 7:42. So thanks a lot. We finished chapter number 3. Chapter number 3. Sorry. Sometimes talk on my own language. And we have a chapter number 4 for the next session. It's about the accounting for limited companies. Just a little theory. And from the next session we have a cash flow statement. We will study about the cash flow statement and do some practical exercises also. Actually, our finance classes always will be based on the practical exercises. But you must also read your books in your home. I mean, at home, you must read the books based on the finance. So all this, you also must remember, this is all the practical exercise that they have given to you. As these ones, same like those, will be on your exams, and you must be able to do them and to get the right solutions. So I think that's all. So thanks for you. I'm going to stop my recording.